For decades, the Swiss franc has been this global symbol of rock-solid financial stability. But behind that reputation, its central bank has been navigating a really complex, decade-long fight over the currency's own strength. So let's dive into this fascinating story of monetary policy under some pretty extreme pressure. And this really is the central puzzle we're going to unpack today. For years, the Swiss National Bank spent billions trying to make the franc weaker. Then, almost overnight, they did a complete U-turn and started arguing for it to be stronger. So what on earth caused such a massive shift? To get to the bottom of it, we're going to walk through 5 key chapters. We'll start with what caused the problem in the first place, then look at the bank's pretty dramatic solution. After that, we'll explore their complete policy reversal, tally up the costs of it all, and finally, tie everything together with a classic economic theory that makes it all make sense. Okay, so our story really begins with a classic case of a good reputation causing a very, very big problem. For Switzerland, being seen as the safest place to put your money was about to become a massive economic headache.
The Swiss franc is pretty much the ultimate safe haven currency. Whenever the global economy gets choppy, investors get nervous. They dump their euros or dollars or pounds, and they rush to buy francs because they trust Switzerland's stability. The thing is, this huge wave of demand pushes the franc's value way, way up.
And that's exactly what happened during the Eurozone debt crisis. As panic grew over countries like Greece and Portugal, money just flooded into Switzerland. The franc soared, and by August of 2011, it was almost 1-to-1 with the euro. Now, this was a total disaster for Swiss exporters. Their products were suddenly incredibly expensive, and it threatened to tip the entire country into deflation. So, the Swiss National Bank, or the SNB, they knew they had to do something. They decided on a really bold and what would become a very famous policy response. They basically drew a line in the sand. The SNB made a public promise. They established an exchange rate floor, announcing to the world that they would not allow the Swiss franc to get any stronger than 1.20 per euro, period. Now take a look at this chart because it's amazing how clearly you can see this policy in action. See inside that red circle? For more than 3 years, the SNB held that line. The exchange rate is almost perfectly flat. It's just a striking visual of a central bank enforcing its will on the market. So how did they pull this off? Well, with a promise of unlimited intervention. Essentially, anytime the franc even thought about going below 1.20, the SNB would just print new francs and use them to buy euros. By flooding the market with their own currency, they could artificially keep its value down. And for years, that floor held. But then the entire global economic environment started to change. Suddenly, we had rising inflation all over the world, a problem that had been pretty much dormant for years. And this forced the SNB to do a complete 180 and reverse its entire policy.
I mean, just look at this slide. The policy shift was a total reversal. The goal went from weakening the franc to strengthening it. And the action flipped from buying foreign currency to selling it. So why the dramatic change of heart?
The answer, in 2 words, is imported inflation. See, when global prices for things like oil and food go through the roof, a country with a weak currency ends up paying even more. But a country with a strong currency basically gets a discount. The SNB realized their strong franc, which used to be their biggest problem, could now be their greatest weapon. And they put this new logic straight into practice. By the middle of 2022, they let the franc strengthen past parity with the euro. By late 2023, they were actively selling their foreign reserves to push it even higher. And by early 2026, the franc had hit a 10-year high. The logic here was crystal clear. A strong franc was now a shield, keeping the price of imports down and protecting Switzerland from the crazy inflation hitting everyone else. But, years and years of intervening in the market, well, that doesn't come for free. The policy of holding the franc down had a massive and very visible consequence for the central bank's own finances. This chart really shows you the sheer scale of the operation. To defend that 1.20 floor, the SNB's foreign currency reserves just exploded from around 500 billion francs in 2014 to over 1 trillion francs by 2021. And then, you can see, as they shifted policy and started selling, that number begins to drop pretty significantly. Now, holding 1 trillion francs worth of euros and dollars is incredibly risky. Think about it. If your own currency, the franc, gets stronger, the value of all those foreign assets just plummets when you measure them in francs. Just to give you an idea, in 2010 alone, the SNB lost 27 billion francs because of this exact effect. So why wasn't this a bigger problem? Well, this quote really gets to the heart of it. Normally, a central bank has to pay high interest on the money it borrows to buy all those foreign reserves. But Switzerland has had extremely low, sometimes even negative interest rates. This meant the cost of funding that massive pile of reserves was tiny, which gave them this unique ability to keep the policy going. And this brings us to the final piece of the puzzle. All of these actions, which seem so contradictory on the surface, can actually be explained by one fundamental theory in international economics. It's called the impossible trinity. And the basic idea is that a country gets to pick 2 out of 3 really desirable policies: a stable, fixed exchange rate, capital that can flow freely in and out of the country, and control over its own domestic monetary policy. The catch is, you can have any 2 you want, but you can never, ever have all 3. And this table just summarizes our whole story perfectly. During the floor era, the SNB chose a fixed exchange rate and free capital flow. But to get those, they had to give up their independent monetary policy. They were forced to print money simply to keep that peg. Then, in the recent inflation-fighting era, they made a different choice. They picked free capital flow and an independent policy to fight inflation. But to do that, they had to give up the fixed exchange rate and just let the franc soar. Which, of course, brings us to today. The journey of the SNB really shows that managing a safe haven currency is just a constant series of tough trade-offs. And as the global economic winds inevitably shift again, the real question is, which 2 corners of that impossible trinity will they be forced to embrace next?